Hello, my name is Don Porter. I am an ACC1011125, Intro to Financial Accounting, and this is my accounting cycle project. This first page is just the general journal for the transactions that occurred from October 1st to November 30th. By and large, most of the entries are pretty simple. We have an initial investment going into common stock on October 1st, and then some purchases, like on October 2nd, paying for prepaid rent with cash, or on the 3rd, paying for computer supplies on account, which puts it into the accounts payable liability. On October 10th, a journal entry wasn't required, although the event of Lynn Addy being hired was listed. No actual financial transaction occurred, so it was not necessary to list in the general journal. It'd be more of an HR thing. But yeah, so for this first page, it's pretty much just recording we paid for this, we record the expense, record how it was paid, either cash or accounts payable, or services were provided, record the revenue, and then record if the customer paid with cash or with or if it was billed. Next, same as the first page, this is just the general ledger. This records the debits and credits for each individual account, and they are referenced with a date for each transaction that occurred. And then finally, a trial balance. This is pre any kind of adjustments, just showing the amount in each account and ensuring that all of the debits and credits are equal to one another. So you have the assets at the top here, and then the liabilities, which is just this accounts payable, and then you have the equity here with common stock dividends and the revenue made, and then expenses, which are recorded as debits. Next part just moves into December of the company's year, and we have a list of transactions that are recorded. Once again, nothing particularly notable. December 14th, the company was paid by Alex's Engineering $1,500 for a bid for a project that had not yet been started. So on that day, the cash that was received from the engineering company was recorded. However, that cash can't be reported as an actual revenue because it hasn't been earned yet. It has to be reported as an unearned revenue, which acts as a liability rather than a revenue account. Basically saying, hey, we owe these people we owe these people $1,500 worth of work, but the $7,200 is for a proposed project, but since no money has actually changed hands for that $7,200 and the $7,200 hasn't been billed or paid by anyone, it would not be recorded in the journal. On the 16th, sending a reminder to the Gomez Company to pay a fee for the services recorded on November 8th. Although it was listed, it was not necessary for it to have a general journal entry, as it is simply a reminder and not a transaction. Yeah, the vast majority of these December transactions follow the same pattern as October and November. We're paying employees expense and then crediting the cash that was used to pay the employees. We received cash here for a previous billed client, so the amount of cash paid would be removed from accounts receivable, which is normally a debit normal balance, so it would be credited for that amount, and then we're just transferring asset to asset. We're taking basically the debit that was in the accounts receivable for money that we're supposed to have, and we got it, so now it's going into our cash account. We have, expenses and the cash paid being credited. On the 20th, services were provided for cash, so we have recorded a debit amount for the amount of cash that was earned, and then the revenue account for our computer services was credited for the same amount. 2A is a general journal entry for the adjusting entries. These are completed at the end of an accounting cycle, and that could be yearly, that could be monthly. It's largely dependent on the company's internal system. So these all take place at the end of the month on December 31st. It's basically just going back through inventory, insurance, depreciation. So for the computer supplies expense, the insurance expense, and the rent expense, they all function essentially the same way, where we have these asset accounts that we've already put money into for a specific purpose: prepaid insurance, prepaid rent, computer supplies. And as the month goes on, although it's not reported in any kind of general journal or books or anything, these accounts do lose value. They're used up, supplies are used and have to be replaced. Prepaid insurance is over a certain period of time. So, like for the 3 months expiring off the 12 months insurance premium, you're taking the overall value that you've paid for the insurance. You can divide it by 12, multiply it by 3, and then you have 3 months of insurance that have expired. And since those have been used up now, they can be reported as an expense and subtracted from their original asset account. The wages payable here are just wages that are owed to an employee that have not yet been paid by the end of the month. And then finally, not finally because they're not the last ones, but the depreciation expenses on equipment, basically the plant equipment, computer equipment, office equipment, stuff that's going to be held by the company for an extended period of time, has to be basically given a lifespan. And as that lifespan carries on and that equipment becomes closer and closer to losing its value to the company, that loss in value is reported as depreciation. So the accumulated depreciation is called a contra asset. It's recorded as a credit that basically subtracts from the original value of that asset, of the computer equipment, without actually affecting the computer equipment asset account itself. And when that accumulated depreciation is increased, it's also recorded as a depreciation expense for that month. Although in this case, for these 3 months, the period that it's taken place in, once again, we just have another general ledger. This is pretty much just copying all the information that was taken down in December. But as opposed to the first one, we now have values for each account labeled on December 1st, because we do have remaining balances from the past 2 months in some of these accounts, like our cash, our accounts receivable, etc., etc. And then there is an adjusted trial balance. So once the adjustments have been made in terms of the expenses, cumulated depreciations, all the adjustments that we made on 2A, we then go back and do another trial balance, just listing off assets, but now we have our accumulated depreciation listed, then we have our, our liabilities with, now we have wages payable, and the unearned revenue that was acquired, I guess I would say, in December. Equity, and then equity revenues right here with computer service revenue, and then all of our expenses listed. And once again, it's really just a good way to like show the values of all your accounts, and you want to have the debits and the credits for all of your accounts equal out to the same value. Then we have an income statement here. So we're just listing our revenue made, and then the expenses that were necessary to gain that revenue. We subtract the expenses from the revenue, and that gives us our net income, or if the company's in the red, our net loss. And that ended up being $22,369. Then we have a statement of retained earnings. This is meant to show basically the net income from that month that we're actually keeping, because we do have, as a business with investors, dividends to pay, which portion of the profits that is paid back to investors as an incentive for investing. So I mean, if you have any kind of stock or whatever, you'll get dividends off of it. Typically, depends on the type of stock. So our actual, the money the company made is $22,369, but the money that the company is actually keeping is $15,069 because we have to pay out to our investors. Then we have a balance sheet. This is quite frustrating. I forgot this right here. And this is similar to like a trial balance, hence balance. And this just lists our assets. We have our current assets here. That's anything that the company will use within a year. And it's generally also like anything more liquid. So cash, that'll be spent going here and there and everywhere within a year, within a day, whatever. Prepaid rent and insurance are both set to expire within a year time. So those are all current assets. Those are things that are being like used and changed on a regular basis. Plant assets are anything that are anything that's intended to be held for longer than a year. So as we saw with the adjustments for the accumulated depreciation on the computer system and the office equipment, they have 4 and 5 year lives. So what that means is they can be used for that long. The accumulated depreciation will consistently rack up over that time as these items lose value. And as they have no salvage value, once accumulated depreciation equals the original value, that's it. They're gone. They're not worth anything. The company. So yeah, plant assets are anything that can be held for more than a year. A lot of times, if the company owns the building, that'll also be included with plant assets. Liabilities are just money owed. This is, unearned revenue is work that needs to be done, wages that need to be paid, and people that need to be paid back. And then the equity is the common stock, which is the investments that have been made into the business alongside retained earnings, which is the money that we're actually keeping after dividends. So then the closing entries basically just set the non-permanent accounts up for the next accounting cycle. So the big one is you're closing out revenues into the income summary, and then you're also closing out all of your expense accounts into that same income summary, and that's going to go like into the retained earnings account. That's not going to give you your final retained earnings, but that gives you, your net income going into that retained earnings. And as you can see here, I messed up the order of these two. The income summary should have been debited for that amount, and then retained earnings credited for that amount. And then as we are subtracting money with the dividends, that debit is taking out $7,300 that needs to be paid to the investors. Finally, this is just another general ledger, and after the closing entries are done, we have the post-closing trial balance, and this gives the overall end of month, end of cycle earnings, just kind of closing things up and condensing them once we've gone through all these processes. So now, as opposed to the giant adjusted trial balance with all the expenses, all the revenue, everything, we can condense this down into a more usable form that just shows us our assets, our liabilities, the common stock, and the retained earnings, which is the equity. And those accounts still need to be balanced out by the end of things. And that is it. Thank you.